When it comes to the world of botched analyst calls, Paycom definitely breaks the chart. Today, we're diving into the murky waters of Paycom's stock, a company that seemed poised for greatness until history decided to change its mind. Paycom's journey has been riddled with missteps, misleading analyses, and downright baffling predictions. As we peel back the layers, we'll uncover the staggering incompetence of 5 analysts who were supposed to guide investors through the storm, but instead made every wrong turn imaginable. How could these so-called experts get it so wrong? What went wrong in their crystal ball gazing that led investors astray? It's a mystery wrapped in poor judgment, and we're here to unravel it piece by piece. But this isn't just about calling out the analysts. Today, we'll show you how their failures highlight the critical importance of diligent investing. We'll dissect their flawed recommendations, explore the repercussions of their blunders, and set the stage for understanding how to avoid these pitfalls in your own investment strategy. Our deep dive will expose the lessons that every investor needs to know. Lessons on how to scrutinize advice, read between the lines, and make informed decisions. And speaking of making informed decisions, if you're looking for a way to generate additional income beyond investing, why not consider starting your own YouTube channel? With Tube Magic by Matt Parr, you'll learn how to harness AI tools to create, grow, and monetize your channel effectively. Whether you're new to YouTube or want to enhance your current channel, Matt's course offers comprehensive guidance to help you turn your channel into a profitable venture. If you're ready to explore a new income stream, check out the link in the description to get started with Tube Magic today. Of all the analysts we covered on Paycom, 2 clear themes emerged. They were all over the place, playing the infamous game of chase with the stock price on their estimates, and even after the crash, none of them initiated a negative recommendation on the stock to this day. Our first defendant today in incompetence court, Siti Panigrahi of Mizuho, is being charged with incompetence and cowardice. Siti began his coverage in October 2017 with a 79 bid. He continued his abhorrent career as a stock price chaser by essentially providing neutral bids while adjusting his estimate to match the stock price more or less. He maintains this position to this day. So let's get this straight. You up your bid from 79 to 500 and back down to 170 as the stock had a bull run and crashed effectively, but was still neutral the whole time. Playing it safe, are we Siti? You need to make a call one way or another, buddy. Let's dig a little more on this one. Shall we make our point? We aren't just picking on Siti. What we will show here is indicative of the bigger problem, and all analysts are guilty. But as you can see from Siti's LinkedIn profile, he is a managing director, so he gets paid easy $300,000 to $500,000 a year, and he's been around for almost 2 decades, so we will call it $500,000 a year. He was on this stock from 2017 to current. That is almost 7 years, we'll call it 6, to be nice to Siti. That is $3 million this incompetent individual got paid to make essentially non-calls on a stock that he must have actually had some sort of opinion on. Look at the movement of the stock. If you don't have an opinion on that, when one of your main focuses is to provide an opinion on that, then I don't know what the hell you are doing. Guilty as charged for incompetence and cowardice. Sentenced to minimum 30 years of sitting in Mizuho's corner with a dummy hat. Our next culprit for the day, Samad Samana, is being charged with 1 count of incompetence. As you can see, Samad and Siti played the same game of chase on the way up with some exceptions. Samad was bullish with his buy recommendation, but cautious with his estimate on the way up, as his chase mimicked the stock price more or less. But in January 2022, Samad decided to go all in with a whopping 620 on his buy call. Way to go, you evaded the charge your friend earned of cowardice. But unfortunately, this was grossly incompetent, as it occurred after the stock had begun to crash, and you were 55% over. To add insult to injury after that, Sit began to chase the stock downward, all the while still touting the stock as a buy, until the very end of the crash, where he told people to hold. Okay, so buy at the peak, pay a premium if you have to, because the stock is that good, then keep buying as it crashes, and then hold your positions as it is in the trench, waiting to gain back the money that you lost. Where do they find these people? Guilty as charged and sentenced to a life of making investments based off of his bogus analyses with his own real money. Our next culprit for the day, Zelnick of Deutsche Bank, was just a little more bullish and incompetent as Samad. He is also being charged with laziness because, as you can see, after his bogusly over-bullish call, after the peak, he really didn't make the effort to reassess that much. Some may argue that it is prudent, but we are firm believers that drastic times call for drastic action. At least Samad tried to make it look like he was at work crunching numbers. This guy was just chilling in the sun sipping culottes while his investors were going bankrupt. And after his last investor filed for bankruptcy in the trenches of the crash, he changes his recommendation to buy hold from buy the egregious. But wait, this gets better. We haven't even talked about what Brad was doing on the way up. Brad made a series of underperform calls, i.e. sell calls, for those of you new to this world when the stock was climbing. Then, in January of 2021, he made a neutral call right before the peak, and then his bogusly overestimated buy call into laziness that we mentioned earlier. So sell or short the stock while it is about to go on a bull run, then buy heavy right after the peak and continue to buy strong as it crashes, only to hold on in the trenches. You can't make this stuff up, guys. It's right on the screen. Guilty as charged and sentenced to every Wall Street guy's worst nightmare, a lifetime sentence of work at your nearest investment bank without the aid of drugs or alcohol. Our next defendant, Stephen Enders, is being charged with gross incompetence. Enders entered the money party a little late, but jumped right in to display a brutal lack of competence on his calls. As you can see from the chart, he made a series of buy calls as the stock was tanking, only to switch to buy neutral in the trenches and then neutral where he sits to this day. Guilty as charged and sentenced to a life of manual number crunching at your nearest investment bank. Our final culprit in today's incompetence court session is Brent Bracelin of Piper Sandler. He entered the party early and actually gets a pass for his early calls because he was spot on telling people to buy before the bull run. But unfortunately, he forgot to clock back into work after the money party he threw at the peak, and thus forgot to reassess his position as the stock tanked. Brent, you were doing so well. What happened? Guilty as charged of incompetence and partying instead of working. So it's clear that these analysts missed the mark completely. And you probably know by now that you shouldn't rely on these so-called experts for anything but a good laugh once in a while. So now, let's dig into what happened and how you can use this information going forward when doing your own due diligence on your investments. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Paycom Software, Inc. is a prominent player in the cloud-based human capital management industry, specializing in comprehensive solutions for payroll, talent management, and employee benefits. Established in Oklahoma City, Paycom has carved out a strong market position by offering integrated HR systems designed to streamline and automate various aspects of workforce management. The company's growth trajectory was notably upward, driven by the increasing adoption of cloud-based solutions and a strong demand for efficient HR systems. This boom was marked by robust revenue growth and a rising stock price, as Paycom captured a significant share of the HR technology market. However, the company has faced several challenges that have impacted its performance. Key financial highs included impressive revenue growth during periods of strong market demand. Yet, the stock price has experienced significant downturns due to various factors, including shifting market conditions, increased competition, and investor skepticism. These issues were compounded by operational and strategic missteps, such as delays in product innovation or execution challenges in expanding market reach. In recent developments, Paycom has made strategic moves aimed at revitalizing its growth trajectory. The company has focused on expanding its product offerings and enhancing its technological capabilities. Despite these efforts, Paycom has struggled to regain its previous momentum. The ongoing challenges and strategic missteps have continued to impact its stock performance, reflecting a broader struggle to adapt and thrive in a competitive and rapidly evolving market. The analysis of the analyst's mistakes reveals several crucial lessons for investors. First and foremost, it underscores the importance of scrutinizing the recommendations and performance of financial analysts. Too often, analysts fail to foresee significant downturns or provide timely advice, resulting in substantial losses for investors. The case of Paycom illustrates how analysts' misjudgments and their failure to adjust their recommendations in response to changing market conditions can lead to disastrous outcomes. When evaluating analysts, it's essential to be critical and discerning. Look beyond the surface of their recommendations and consider their track record, the assumptions behind their forecasts, and how they respond to market shifts. Analysts should provide clear, actionable insights based on sound research, but often they fall short of these expectations. Conducting thorough research is vital for making informed investment decisions. Investors should closely examine key financial metrics such as revenue and earnings growth, especially in companies with high price-to-earnings ratios. For instance, while Paycom's current PE ratio of 19 might appear reasonable, it was previously around 166 at its peak. This dramatic valuation shift, coupled with inadequate revenue growth, should raise red flags. Additionally, in a rapidly evolving market, a lack of product innovation and poor market research can significantly undermine a company's potential, especially for those trading at high valuations. Critical thinking is indispensable when assessing investment advice. Always approach analyst recommendations with a healthy dose of skepticism and perform your own due diligence. By staying informed and cautious, you can better navigate the complexities of the market and avoid the pitfalls that come with relying solely on external advice. Be sure to steer clear of other people's judgments, for if you rely on these solely, you are behaving just as incompetently. You may find yourself on our list of defendants one day. So do yourself a favor and do your own cautious analysis, especially on high P stocks. Check this video out for a deep dive on ALB, another one of history's recent bloopers stained with incompetence.